You're sitting in a job that feels stable, your bills are paid, and the unemployment rate says the economy is fine. But your employer quietly stopped posting new roles 3 months ago. That freeze is already happening across the country, and the official number isn't showing it yet because there's a specific mechanism that's holding the headline artificially in place. Most people have no idea it exists. Today we're breaking down what that mechanism is, why it means the real number is closer to 5.5 or 6%, and what that gap means for your income, your savings, and the financial decisions you're making right now. Let's start with what your employer already knows. The unemployment rate, the number that gets flashed across every financial news segment, is sitting around 4.4%. Sounds manageable, sounds almost fine. But inside most HR departments right now, the conversation is different. The postings are getting pulled quietly, the backfill requests are getting denied, the headcount approvals are stalling. They're not watching the headline, they're watching the real hiring data. And the real hiring data looks nothing like 4.4%. Here's the first number that should stop you cold. It's called the hires rate. It measures the percentage of workers who are newly hired each month across the entire economy. Right now, it's sitting around 3.3%, lower than the dot-com crisis. For perspective, the hires rate bottomed out just below 3% during the worst of the 2008 financial crisis. We are almost there today, not approaching major crisis territory, sitting at the edge of it. And here's why that matters more than most people realize. When the economy starts to weaken, companies don't immediately cut staff. They stop hiring first, they let openings go unfilled, they quietly freeze the intake valve. Layoffs are the last signal. The hires rate is the first. And right now, the first signal is screaming. Think about what that means for someone like Marcus. Marcus is a marketing manager in his mid-30s. He's been in his current role for 2 years and he knows he's underpaid. In a normal market, he'd be actively interviewing, leveraging competing offers, negotiating a 20% raise, or switching companies entirely. But Marcus isn't doing any of that. He's sitting still. He's sitting still because he looked around and the roles he'd normally move to have either disappeared or been frozen. He doesn't want to be the last one hired somewhere right before a wave of cuts. So he stays. He eats the salary he knows is too low, and he quietly stops expecting things to get better anytime soon. Marcus is not an outlier. Marcus is the entire US labor market right now. There's a number that captures exactly what Marcus is experiencing at scale. It's called the quit rate. The quit rate measures how many workers voluntarily leave their jobs each month. When workers are confident, when better opportunities exist, that number rises. When workers are frozen in place, it falls. Right now, the quit rate is around 2%. That matches dot-com crash territory. Workers are more reluctant to leave their jobs today than at almost any point in the last 25 years. Not because they love their jobs, because they don't believe something better is waiting on the other side. And job openings confirm it. The number of open positions per unemployed worker just hit its lowest point since COVID. At the same time, the share of workers who say jobs are hard to find has more than doubled, from roughly 10% to over 20%. The share saying jobs are plentiful has collapsed from 55% down to about 25%. This isn't opinion data, this is workers describing what they see when they look for work, and what they see is a market that's closing. So here's the question that should be bothering you by now. If the hires rate is near 2008 lows, if the quit rate is near dot-com crash levels, if workers can't find jobs and openings are drying up, why is the headline unemployment rate still sitting calmly at 4.4%, just slightly higher than where it was a year ago? This is where the mechanism comes in. The one buried inside how the number gets calculated, the one your employer already understands. The unemployment rate doesn't measure how many people don't have jobs. It measures how many people are actively looking for a job and can't find one. That's a critical distinction, because if less people are looking, if they drop out of the search entirely, less people are counted as unemployed. They simply disappear from the calculation. And right now, the pool of people actively looking for work is shrinking. Hard. 3 forces are driving that contraction simultaneously. Labor force participation is declining. Baby boomers are aging out of the workforce at scale. And there's been a significant drop in foreign-born labor entering the market. Fewer people looking. Same number of jobs. Mathematically, the rate should be dropping. But it's not. And here's what makes this dangerous. The demand for workers is falling at roughly the same rate as the supply. Hiring is collapsing at the same pace the labor pool is contracting. They're moving in sync, which is why the headline looks calm while the actual job market deteriorates underneath it. Supply and demand declining together. The headline, frozen. The real economy quietly getting worse. That's bad enough. But if unemployment rises, as it did recently, while the labor force shrinks, that's a much stronger signal that the economy is deteriorating more rapidly. According to analysis from Bankrate, if the labor pool had kept growing at its 2024 rate, unemployment would already be well over 5%. And because the labor force is shrinking, the economy only needs to create roughly 30,000 new jobs a month to keep the headline from rising. In most historical contexts, 30,000 jobs a month is what a recession looks like. We managed about half that in 2025. Let that land. We are producing recession-level job creation behind a headline that says 4.4%. The real number, the one the underlying data points to, is somewhere between 5.5 and 6%. How do we know? Because the indicators that have historically correlated with true unemployment levels are all pointing there. When more than 25% of unemployed workers have been out of work for 6 months or longer, which is where we are now, typically unemployment has been around 5.5%. When the hires rate sits at 3.3%, it has historically occurred alongside unemployment above 6%. The official number says 4.4%. The data says something different. And the gap between those two numbers is the most important financial story almost nobody is talking about. Now here's where this stops being a labor market story and becomes a your money story. Consumer spending is 70% of the US economy. 70%, it is the engine. When workers are frozen, when millions of people like Marcus are sitting in underpaying jobs, not switching, not getting raises, not negotiating from strength, spending deteriorates. Not dramatically at first, quietly. People stop upgrading, they delay the car, they roll over the credit card balance instead of paying it down. The grocery bill gets managed more carefully. That compression doesn't stay contained, it moves downstream. When spending decreases, corporate revenues soften. When revenues soften, earnings estimates come down. When earnings estimates come down, the market reprices. And right now, the market is priced for a healthy labor market because it's responding to 4.4%. Not the quit rate, not the hires rate, not the shrinking labor pool. But when the headline finally catches up to the underlying data, the repricing won't be gradual. This exact setup has run twice before in recent memory. In 2007, every leading indicator in the labor market was already deteriorating. The hires rate was sliding. Job openings were thinning. Workers were getting cautious. But the headline unemployment rate looked manageable, so most people felt fine. September 2008, Lehman collapses. December 2008, 533,000 jobs lost in a single month, the worst since 1974. The headline had been masking the pressure for over a year. In 2001, same pattern. The dot-com collapse had been building in the labor data for 18 months before it showed in the official numbers. When it finally corrected, 1.7 million jobs lost. Both times, the leading indicators were flashing. Both times, the headline was the last to know. The people who read the real data in 2007 had time to act. They built cash reserves. They reduced exposure in the assets most tied to consumer spending. They weren't trying to predict the exact date. They were simply responding to what the data was already showing, before the headline confirmed it. That window exists right now, but it doesn't stay open once the correction starts. Here's what to watch for the confirmation. A substantial spike in layoff announcements. We saw 108,000 in January alone, and February followed with another over 90,000 jobs lost. Watch for the hires rate dropping below 3%, where it bottomed in 2008. And watch for a sustained rise in weekly jobless claims. Any one of those moves the headline. All three together moves it fast. And when the gap between 4.4% and 5.5 or 6% closes, it doesn't close gradually. It corrects violently. And it shocks everyone who wasn't watching the leading indicators. Now you know something the headline number doesn't tell you. You know why the rate is frozen. You know what the underlying data says the real number is, and you know the historical pattern that follows when that gap finally closes. The question isn't whether the headline catches up. Based on every data point we've covered, it's when. The only real variable is whether you're positioned before it does or after. If this shifted how you read the labor market, hit subscribe. We publish fresh content several times a week to help you protect and grow your wealth. And none of this is personal financial advice. This is education so you can build your own plan. Next, watch something that is relevant to what is coming. The new Fed chair has a plan to reduce the debt. You won't like it. It's on the screen. In the description, you'll find links for 10% off Seeking Alpha Premium and Alpha Picks. They've crushed the S&P since 2022. You'll also see a link to my Wealth Builders Blueprint, a list of resources that can help you grow your wealth. I also included a link to Zacks Confidential, a stock recommendation service with dual money-back guarantees. Check them out. Thanks for watching. See you on the next one.